Hi everyone, in this video we're going to be reviewing the slides and I'll be discussing chapter 6. And in chapter 6 we're going to focus on the financial statements and closing entries, and this is kind of continuing on in our discussion of the overall accounting cycle. So with that said, let's dive in. Okay, so to begin, we're going to start by talking about preparing the financial statements, and then we'll move on to closing entries, post-closing trial balance, a discussion of a classified balance sheet, and then some additional topics down here, including analyzing financial statements, and talk a little bit about how things have evolved from a manual environment in terms of accounting and financial statement presentation, etc., to more of a computerized accounting environment that we find ourselves in today. Okay, so to start, we're going to talk about, like I mentioned, preparing the financial statements. And so as we've kind of proceeded through the accounting cycle, we've analyzed our source documents, we've posted journal entries in the general journal. Then we've taken those journal entries and we posted them to the general ledger, to the specific ledger accounts that exist for the respective accounts that those journal entries have impacted. And we basically aggregated all of the accounting transactions for the entire accounting period in the general ledger. And then we've taken that information and we've made adjusting entries as necessary to make sure that we are capturing all the revenues and expenses that need to be accrued or incurred, etc. And so now we've got an adjusted trial balance. And at this point then, we're going to be able to create financial statements, and the same financial statements that we've been talking about throughout the course, the income statement, statement of owner's equity, and the balance sheet. So here's a little presentation. Again, like I just mentioned, we are now kind of in this area with step 7, step 8, and step 9. So as we get through the chapter here, we're going to be kind of finding ourselves at the end of this cycle, but then that cycle will just continue to repeat as we go forward into the next accounting period. Usually, whether that be the next month, which is typical in a computer system as we're rolling forward month to month. But also the accounting period could kind of encompass an entire year, and then the beginning of the next year would just start over with step 1. Okay, so as I mentioned, we're at the spot now in this chapter where we've posted the adjusting entries for depreciation and interest accruals and prepaid expensing of prepaid expenses, etc. And we're going to take those numbers here into our adjusted trial balance. And here is the spreadsheet. We call it a worksheet down here. And so this is not a financial statement per se. It's really kind of just a way to visualize the adjusting entries that will take us from an unadjusted trial balance to the adjusted trial balance. So as you can see here, you're going to start with, like I mentioned, unadjusted trial balance with, for example, a good spot to review here would be for depreciation. So recording depreciation expense is a very common adjusting entry. And so we'll still post the adjusting entry, and then that's just a general journal, or it's a journal entry, and it will have a debit and a credit and all that. But this is just a way to kind of visualize those adjustments. Again, we still post in the general journal. We still put those adjusting journal impacts into the general ledger, etc. So nothing has changed, but we can prepare this spreadsheet or worksheet in order to kind of see, here's where we were before our adjustment. So accumulated depreciation had no balance. Then we post an adjusting journal entry for depreciation, which will be this 150, and then depreciation expense, so the debit and the credit. And then we can see, after posting the depreciation expense journal entry, now we have a $150 credit balance in accumulated depreciation, and depreciation expense has a $150 debit balance. So it started, with nothing. Then we add, where we do a debit to that, and then it ends up, with that debit balance, essentially. Some other examples. Let's look through here and see. So one here, service revenue, for example. We've got a credit for $1,200, it looks like, and we probably had some unearned revenue here on the other side. And so you can see that, for example, or actually, let's focus in just on the unearned revenue portion up here, because I think this revenue entry is the combination of these two. So it looks like we noticed when we were done with our monthly accounting that we needed to accrue an extra $1,000 of revenue. So we did a debit to accounts receivable. So we had a beginning balance of $3,000. We did our adjusting entry. So we had a debit balance. That adjusting entry was a debit to increase accounts receivable. And so we end up with a $4,000 ending adjusted balance for accounts receivable. And then unearned revenue, we had $2,000, but it looks like we actually earned $200 of that during the month of January. And so we had a credit balance to start in unearned revenue. Then we earned $200, so we're going to debit that credit balance to reduce it. So now we end up, so credit gets debited, reduces the credit balance down to $1,800. And then the combination of earning the revenue from these two adjusting entries is then added together to give us a increase to service revenue of $1,200. And hopefully you're seeing how, the service revenue had a credit balance of $3,300 to start. These two entries both increase revenue. And so we have a credit to increase revenue, just the normal impact to revenue. And then you add those two together to get our final balance of $4,500. So again, this is just a tool for us to be able to visualize the impacts of all of the adjusting entries in a real clear and easy format, and what all that we did to take us from an unadjusted trial balance to now an adjusted trial balance, which is now ready for us to use in the preparation of our financial statements, because we don't want to prepare our financial statements until we have all of the information captured. So that's why we need to do those adjustments. Okay, now we've talked about the income statement previously, so nothing too interesting to speak on here necessarily. They're just showing an example of, here's an income statement before the adjustments that just has revenues and a couple of expense categories. And then it's noting, kind of like what I just said, is the reason we want to post those adjusting entries is because if we didn't, then we would be missing this depreciation expense, the insurance expense, and the interest expense that do need to be captured. And we would also be missing, you see here, $3,300 of revenue is before the adjustments. And so we would have been missing the $1,200 of revenue that we added in through those adjusting entries. So it does change the net income by a decent amount, and we want to make sure we do our adjustments before we prepare our financial statements, or else our financial statements, if that like this, are really inaccurate. So that's a requirement to do the adjusting entries. Okay, now the statement of owner's equity. I'll run through this just real quick. I think we've spent a decent amount of time looking at this statement. Nothing new really here to consider necessarily from the previous chapters that we have analyzed the statement of owner's equity, but maybe just a reminder that we have capital at the beginning point. So this is our owner's equity at the beginning. If we have investment, we're going to add that in to capital. Net income will increase capital. If it was a net loss, it would decrease capital. Then we have withdrawals, which would reduce capital, money taken out of the business, and that gets us to our ending balance. And then this will go off to our balance sheet. And then again, as we've talked about lots of times so far in class, our balance sheet, it's a snapshot of our financial position at a given point in time. And we're preparing the financials, the balance sheet now using those adjusted assets. So accounts receivable is accurate. We have an accumulated depreciation amount now, etc. And we did not have those adjusted to the correct balances before we did the adjusting entry. So again, just highlighting the fact that the adjusting entries are a necessary component of our accounting work that need to be finished really before we can prepare our financial statements, because without them, we're going to have financial statements that are missing some key information, and the balances really won't reflect accurately. Excuse me. Okay, our first question here says, which of the following statements is true about the statement of owner's equity? And we've got a couple different options here. Option A, it links the income statement to the balance sheet. And that, I think, is going to be the one that we want, because if you remember our statement of owner's equity, we have to calculate net income from the income statement, and then that carries over to the owner's equity statement, which is the second statement. And then in that statement, using net income or net loss from the income statement, the owner's equity statement calculates ending equity, and then we take that over to the balance sheet. So it's that step 1, and then step 2, and then step 3. These two are not right. So yeah, it links the income statement to the balance sheet. That's the answer there. True or false? By analyzing the balance sheet, the revenue for the period can be observed. Not really. That's kind of it's backwards looking. Like I said, you really want to start with the income statement, because that is directly where we're going to represent the revenues and expenses, and then add those together and either get net income or net loss, which then carries forward to equity statement, and then the equity ending balance carries over to the balance sheet. Okay, now we're going to talk a little bit about closing entries. So I think we've seen this a little bit, some of these impacts, or what I'm going to talk about here in our work that we've done so far throughout the whole class. But we're going to formalize this concept a bit here. And the concept specifically is this idea that we have certain accounts that are temporary and certain accounts that are permanent, or real accounts, quote unquote real accounts. And those permanent accounts are all the accounts that you find on the balance sheet. So that will be all of our assets, our liabilities, and our owner's equity. So it's really kind of like our accounting equation, A equals L plus E. Those are the permanent accounts. The temporary accounts are the things that are a component of owner's equity, right? And those things are income statement accounts like revenues and expenses, and also the owner's withdrawals, etc., and the investment accounts, which would just go directly into capital. So those things, withdrawals, revenues, expenses, contributions, those will all go to zero. And that process, we're going to close those accounts, as it's called. And so that those balances, for example, in revenue, for instance, the revenue that we see in a given accounting period, like the revenue for January, for example, is only going to pertain to January. And then when we start February, we're going to have a closed out revenue account. So it will start with zero, and we'll record all the revenue again just for February, for instance. And then we'll close that revenue account again in February, and we'll start fresh with the revenue account at zero and build it up in March. So it just continuously, the revenues, expenses, withdrawals, and contributions just go, we close those out at the end of every accounting period. Basically, they go to zero, and then we start building them back up again at the beginning of each accounting period, the next month, for example. And again, to contrast that against the permanent accounts, which are the assets, liabilities, and equity, those balances, for example, if you had a $10,000 cash balance at the end of January, that $10,000 cash balance at the January 31st becomes the beginning balance in February. So those permanent accounts, those assets, liabilities, and equity, they do carry over to the next accounting period. And that's a key concept here. So this is just kind of breaking it out a bit. Permanent accounts and the temporary accounts. Okay, so there's a couple different methods that we can use to do this closing of those temporary accounts. There's the direct method, so we're going to look at that now. And in this method, we're basically going to close these temporary accounts directly to owner's capital. So here it's got an example of service revenue. So the customer paid us cash. We recorded revenue for this accounting period. We need to eventually increase our equity for this revenue that we earned during the month, and that's going to be done through the process of closing. And here's a similar situation where they're saying, if we have a telephone, bill that we received, for example, we now have some expense during this month, and we need to eventually, those revenues and expenses will show on this period's income statement. But going forward, we want to zero those revenues and expenses out and basically update our equity account for these and update this balance. And then that updated balance in equity is going to roll forward to next month. So again, the way that we do that, like I just said, to close these things into capital, so here's revenue. We've got a $1,500 balance before we close. In order to get this to go to zero, it's a credit balance. And so in order to get this to go to zero, we just need to debit it for the same amount. So you currently have a $1,500 credit. If you debit that for $1,500, that means this is $1,500 minus $1,500 goes to zero. And then this is our debit of that closing entry. And then the credit of that closing entry goes directly to equity and the specific capital account for that owner. And if you really kind of step back and look at this, what's happened is we've essentially taken the revenue that was a credit in revenue here, this $1,500, and we've essentially moved it down to being a credit in the equity account instead. So that's sort of the actual mechanical flow of what's happened. And what happens, just from closing the revenue account, is that capital increases to $6,800. And service revenue goes to zero. And again, it goes to zero because we're just kind of cleaning it out or clearing it out to zero so that it's ready to begin being built up again in the next month. So we only do this process of closing these temporary accounts out as the very, very, very last step of the accounting cycle, really just as a part of preparing for the accounting that we're going to do in the following month or accounting period. Similarly, with telephone expense here or any expense, expenses are normally a debit. So if we, in this example, we have a $250 debit telephone expense, and so we want to credit that, which reduces this original $250 down to zero, and then this is the credit side of that closing entry, and then the debit side goes directly to capital or owner's equity here. And so you can see that the combination of these two, expense and revenue, means that our ending balance of equity or capital is now $6,550. So we've essentially, again, just like with revenue, because it was before we did this closing entry, there was a debit balance in telephone expense account. Now we've essentially just moved this debit over to capital. That's what, again, is the effect of doing these closing entries. And then the way we get to 6,550 is just 5,300 would be our capital from last month. We add 1,500 of revenue and we subtract 250 of expense, and that brings us to the ending balance here we see of 6,550. And as it mentions here, that's basically what I just said. The end result is that owner's capital, so the equity account, will have a new balance, and the assets will still equal liabilities plus equity, no difference there. But the revenues and expenses and withdrawal accounts, those temporary accounts, all of these highlighted things will end up with a zero balance. I kind of think of it like you sort of like take all of this activity of withdrawals, revenues, and expenses and kind of smush them all down into one number and then move that number, whatever, if it's a debit or credit, we're going to update the capital balance with that resulting debit or credit amount after we add these all together. So 2,000, plus all this minus 4,500, whether that's a debit or credit, we take whatever that is and move it into capital. And as I mentioned, essentially to reset the temporary accounts for the upcoming accounting period. And again, we're doing the direct method here. We're going to talk about the indirect method, which is what we'll use more often in our homework problems and on a test, etc. But this is the direct method. And when we say direct, we're talking about the fact that our closing entries, which is what we see here, are posted directly to capital. There's no intermediary account. Revenue is the debit, which makes revenue go to zero, because it was before you did this debit, it was a credit of 4,500, and then it just updates to move that revenue to the capital account essentially. And same thing with the expenses, and the same thing with the withdrawals. And then it shows here the net result after taking into account also the owner's withdrawals, all of the expenses, and the ending revenue, is that it ends up with an 11,475 ending balance in capital. Okay, and so that was the direct method. Now we're going to shift our focus a little bit and talk about the indirect method, or the income summary method, if you will. And so it's this method is essentially the same process. We're going to update our equity account, our capital account, for all of the same things, revenues, expenses, withdrawals, all those temporary amounts will be closed into the capital account. But we're going to use this intermediary account called the income summary, and we're going to move the expenses and the revenues into this income summary account first, and then move the net balance from the income summary account to the capital account. And one nice thing about doing this method with the income summary is that you're able to see a little bit more clearly that that the amount that gets closed into capital from the income summary is the same amount as the net income as shown on the income statement, because really all we're doing is comparing revenues and expenses and offsetting those two in order to get a balance. So it's a little bit of a check, or make sure that we're capturing everything in the closing entry. With this method, it's a little easier because you're going to end up with a net balance on our income summary that will match the revenues minus expenses on the income statement. So here's a comparison as well. So direct method, assets equal liabilities plus owner's capital, and you can see it directly is adjusting capital for the owner's withdrawals, revenues, and expenses. And then the income summary method just adds this extra intermediary step of the revenues and expenses first going to this income summary, and then the net of the revenues and expenses, which again is either the same, it's either a net income or loss, and that's going to match what's on the income statement. That balance then goes into owner's capital. So it's really the same outcome. It's just we have an extra step for the revenues and expenses where we net them, add them together into this separate income summary account. Okay, a few questions here. Which one of the following types of entries is required to close an expense account? So remember that expenses have a normal balance of debit. If you want to think dead circle, remember that they are under the DEAD part of the dead circle, which means that they increase with the debit or have a debit normal balance. And when we're doing closing entries, we want to do the opposite. We want to do reducing entries to reduce them to zero, to close them. And so we would want to be crediting these expense accounts to close them. So our answer there is B. Okay, which one of the following types of entries is required to close the owner's withdrawals account? So remember that withdrawals or draws is also under the D. So it's the dead. The DEAD is for draws, which is just a shortened name for withdrawals. And so again, that means that withdrawals have a debit normal balance, or in other words, an increase is a debit. And so if we're going to close that account to get it to go to zero, to reset it for the next month or the next accounting period, we're going to credit that withdrawals account. We're going to credit the withdrawals account, and we're going to debit the capital account. So here we can see the answer then is going to be the other side of the entry that's not direct to the withdrawals, but rather is the debit to the owner's capital account. So remember, it's still normal journal entries. There's a debit and a credit. And we'll do a lot of practice with these. They're a little tricky to understand, I think, when we talk about it in this kind of theoretical way. Hopefully, this lecture will help you get some context, but they sound a little scarier, I think, than they actually are. When we start practicing some of the problems, I'll teach you some mnemonic devices that will help guide your thinking, similar to the dead circle little trick or tool. And the closing entries, while they're a little tricky at first, they're very mechanical, they're very consistent and similar every time. So you really just need to kind of learn the process and then just repeat it every time. So maybe you'll take some comfort in knowing that they're actually not too difficult once you learn to do the mechanical process of it. It's not super difficult. I don't think. There's some, like I said, some mnemonic devices to help you memorize the steps, and then you just repeat this every single time. So don't get, if you're feeling a little overwhelmed, take some comfort in knowing that we're going to practice a lot of these, and they're basically all the same. And so once you learn the steps, it's basically the same every time. So okay, so now we're going to talk a bit about the post-closing or post-close, the closed trial balance, a post-closing trial balance. Okie dokie. So as we've been discussing, the temporary accounts, the revenues, the expenses, the withdrawals, they all get closed. And then once those are closed, what we're doing is basically putting those balances, you're updating capital, the equity account, to reflect all that information. So the beginning balance of capital will go up for the revenues, down for the expenses, and down for the withdrawals, essentially. And after doing those closing entries, and we've moved this activity, like I just mentioned, into capital through the effect that they have, the increases and decreases, etc. After we do that, all those temporary accounts are basically kind of reset, if you will, or they'll have a zero balance that we can, again, roll forward to the next accounting period and start building back up. But they'll have zero balances. So on the trial balance at this point, any of those temporary accounts are just not going to be there. They don't have any balance in them at all. So we have kind of a post-closing trial balance here, and essentially what this post-closing trial balance represents is just all of the permanent accounts. And like we mentioned earlier, the permanent accounts are the assets, the liabilities, and the equity. It's just like our accounting equation that we always talk about, right? So it's none of the revenues, expenses, or withdrawals, etc. It's just equity as one number. All those things basically combined, those subcomponents of equity all combined down into this one line item here. But we still have the liabilities here, accounts payable, etc. We have all the assets, contra asset for accumulated depreciation. So it's just, and it's also what you see on the balance sheet. That's another way to think about it. So, okay, so which accounts have zero balances? Like I just mentioned, it's all the ones that are temporary accounts, and it is revenues. It's all of these withdrawals, revenues, and expenses. So our answer would be D. Okay, so again, just to revisit this real quick, this is the final step in our accounting cycle. After we've recorded everything, we've done all the adjusting entries. This is the thing, the closing trial balance is really the starting point for our next period, accounting period. So this was January. This just becomes our starting point for February. So February will have a beginning balance of $3,800 in cash, $4,000 in accounts receivable, so on and so forth. It will have a zero balance for revenues. So right when we start recording revenues, expenses, withdrawals for February, those are going to start having balances and making, changes and all that kind of stuff to the accounts. But this ending trial balance for January 31st is really just the thing that we carry forward to February and start doing our accounting on in February. It's really our beginning February balances, if you want to think of it that way. Okay, so here in this section of the lecture, we're going to talk about the classified balance sheet and the difference between the balance sheet that we've seen so far and this idea of a classified balance sheet is that we're going to do some additional grouping in the balance sheet beyond just assets, liabilities, and owner's equity. We still have those primary categories. We're still going to have those high-level accounting equation type categories. But as you can see here, we are going to further subdivide assets into current assets and non-current assets. And we're going to divide liabilities into current liabilities and long-term liabilities. So similar terminology too. It's funny how it's just non-current assets. They don't say non-current liabilities, I guess, but long-term liabilities. But they essentially reflect very similar types of things. So, in terms of doing these categorizations or organization here, the division of these things into the categories really reflects the fact that these are assets that are going to be recognized, or they're going to become liquid or used up or become cash sooner, or they're already cash, like cash, or they're non-current assets like plant, property, and equipment. It's things that will be depreciated because these are going to be assets, like it says here, that are not going to be turned into cash or used up within the next 12 months. So when we're talking about property, plant, and equipment, we're talking about equipment that has some life, a useful life, like we've talked about for depreciation expense. Maybe it's 5 years, maybe it's 7 years, maybe it's a building, maybe it's 30 or 40 years, etc. But basically, it's just longer than 1 year, puts it into the non-current category of assets. And then very similar with current liabilities versus long-term liabilities or non-current liabilities. The current liabilities, like accounts payable and unearned revenue, are kind of assumed to be the types of liabilities that will be paid off within the next year. And then the long-term liabilities, and the year, when I say in the next year, that would be the following 12 months of whatever this date of the balance sheet is. So if it's December 31st, 2024, the next 12 months, is ending December 31st, 2025. And so a long-term liability is something that's going to be repaid after December 31st, 2025, after those next 12 months, essentially. So we really use that 12-month term, that period of time to delineate between what's current and not current or long-term. And here's an interesting concept, is that when we're talking about long-term liabilities, some of the types of liabilities that we have actually have a current component and a long-term component, right? Because like I just said, the current component or what makes a liability current or not long-term is that it's going to be paid in the next 12 months. So when we look at a long-term bank loan, for example, here we have if our company had a $50,000 bank loan, and that bank loan here in our example will be paid off in 5 equal installments, so $10,000 payments over 5 years, and at the end of that, we will have paid off the full balance, paid it all back to the bank. But if we're making payments in equal installments every year, then in the next year, we're using December 31st, 2017 as an example. And so sometime in the next year, we're going to make a $10,000 payment because we're making one payment every year. So one of those years is the next 12 months, but then the other 4 years are beyond that next 12 months. And so the 10,000, the upcoming payment, the most current one that'll happen in the, during 2018 will be current, but all 4 of the rest of the payments that are going to happen in 2019, 2020, 2021, 2022, those are all beyond the next 12 months. And so those will be long term. And then you can kind of see how this changes. So that was at December 31st, 2017. But once we've actually made that payment, say, and we're now at December 31st, 2018, this 2019 payment now becomes the next current, 10,000, because it is going to be paid within the next 12 months from the balance sheet date. And so now there's only 3 payments left, 3 payments of $10,000 left to make. That will be beyond the 12 months, as opposed to 4 payments here when we were talking about December 31st, 2017 versus December 31st, 2018. And this will continue to change. The 10,000 will stay the same every year because we're making a $10,000 payment every 12 months, basically. But this long-term portion will continue to get shorter, and then it will disappear eventually. We'll only have a current portion when there's only one 10,000 payment left to make within the next 12 months. And then once that payment is made, the whole thing goes to zero. But anyway, that's the idea there, is that it's not always, you do have these types of situations or line items, for example, on the balance sheet or accounts, like a notes payable account, where the actual general ledger account is not necessarily split into current long-term. It might be, you could have separate accounts to break these things out actually with, debits and credits, but it could be just be in one account. But we definitely, on our classified balance sheet, want to make sure that we separate the amounts out into their current and long-term portions. And then we've got an example of what this classified balance sheet is going to look like here. So again, we've got current assets broken out and totaled up. And then we've got property, plant, and equipment broken out, which is the non-current asset. It kind of doesn't have the exact wording of non-current asset. I think it's because this is the only category. Whereas if you had multiple non-current assets, you would probably have a header that said that, and then little subcategories below. But everything that's not a current asset here is just, you kind of can infer that. Equipment, and then the related accumulated depreciation, and then you just add those together again to get total assets. So historically, or previously, when we were looking at a balance sheet that was not a classified balance sheet in earlier chapters, we would have just listed these all together. There'd be no current asset, subtotal, etc. So it's really not changing anything about how a balance sheet is presented as far as assets and liabilities and totals and stuff. It just adds subtotals and categorizations of current versus non-current. And then the exact same thing with liabilities. We put our current liabilities all in one section, and then the long-term liabilities are broken out below to show us here. And again, like I mentioned, we were just talking about, our notes payable gets broken out so that there is a current portion of the notes payable in current liabilities, and then there's a long-term portion of the notes payable, and that's going to be in the long-term section. So you just have to possibly do a little bit of analysis, figure out what part of a debt balance that's owed is going to be paid in the next 12 months, and that's the current portion, and then everything else that will be paid after the next 12 months just goes down with the long-term. And then capital basically doesn't really change on the classified balance sheet. It's really just about breaking out current versus non-current on assets and liabilities. Okay, here's a question. Suppose that a notes payable is due within 1 year. What type of debt is the notes payable considered? Well, since it's due within 1 year, means that the full balance is going to be paid within 12 months. And so we would consider that a short-term notes payable. Okay, a company buys and sells real estate property. Each piece of property is sold for cash within 1 year after it's bought. What type of asset is the property? So again, if it's being sold within 1 year is the key thing to look for here. And so if it is being sold in that 1 year, it's going to be short term. It's not going to be non-current. Again, is things that are long-lived and not expected to be turned into cash within the next 12 months, which is not what they're telling us. This is here. They're saying it is going to be sold within the next year, so it's short term. Okay, so we're going to talk a little bit about financial statement analysis here. We'll do a lot more of this you will do more of this if you take accounting, the financial accounting course at Butte. We spend more time looking at different ratios, etc. But we'll talk about it a little bit here just to give you some exposure. And the idea of analyzing the financial statements, is we've done all this work, right? We've done our normal accounting, we've done our adjusting entries, we've prepared these financial statements, and we've just prepared our classified balance sheet. So now we have current assets, broken out, current liabilities broken out from non-current, etc. And so now with all this information, we have this report, this balance sheet, for example, and we have the other reports as well, income statement and stuff. But here in these examples, we have our balance sheet in front of us. We can now kind of look at the outcome and make we can do some analysis on that to give us some information about the business's financial health, if you will, or at least the financial position. How is the business doing from a metrics or an analysis perspective? Okay, so there's a few typical kinds of ratios, calculations that are done, and it doesn't, when I talk about these analyses too, it can be internal, right? Management and the owners might want to review these things to understand how these metrics are holding up in terms of internal analysis. But also a lot of times external parties are going to be really interested in this as well. So for example, if you're going to get a bank loan, the bank might require you even to maintain a certain ratio of these things. I guess I should say first, in order to obtain that loan, you might have to prove to the bank that you have a favorable, these metrics, these ratios are favorable, or they meet the needs of the bank, and you can show them, hey, we're in a good financial position to be able to repay a loan, etc. So that can be a necessity at the outset of borrowing money. And then the bank might also say, okay, we're going to review your financial statements periodically, and based on that financial information, you have to maintain certain ratios. And if you don't, there could be penalties, or the bank could say, we'll force you to repay us immediately, so on and so forth. So anyway, that's sort of how the analysis is used. Some examples of how it can be used. And those ratios then in specifics, we've got some examples here, working capital. And so as it notes here, it's the excess of current assets over current liabilities. So just taking your current assets minus current liabilities, and that shows you, how much working capital you have. And if you think about it, if your current assets are lower than your current liabilities, which you can sort of think of it as, say, the gist of this essentially is that if your current liabilities, the things you're going to have to pay soon, are more than the current assets, so kind of the assets that will turn into the cash, or just the plain cash that needs to be used to pay those liabilities, if that's less than the current, you might run into a problem. The business might run into a problem. Essentially, the business might not have enough money to pay off the bills that are coming due, in other words, and from a external banker perspective, that's bad news. It's a bad news from an owner perspective, internal as well, and would maybe indicate that the business is having some issues and may have problems, repaying its debts and just really continuing operations. Because if it can't pay its obligations, whether that's payroll, if its employees leave, or it can't pay its accounts payable and its vendors aren't being paid, the vendors aren't going to do any more business with you if you're not paying your bills. And so that's not a good position to be in. So you want to maintain a good amount of working capital. The current ratio is similar to working capital, but what we're going to do here is just take those current assets divided by current liabilities. So working capital was the current assets minus current liabilities. Current ratio is just current assets divided by current liabilities. And so doing it that way gives you a kind of a percentage or a specific comparison number. And the higher that current ratio is, that it just kind of tells us what level and how much current assets do we have to pay off our debt. So these two things are very related. Just doing this ratio sort of gives us a quick visual representation, like I said, sort of from a percentage perspective. And the banks or even internally can kind of benchmark that, and like I said, the banks might have in their contracts with you that you have to have a certain current ratio. So, and if it goes below that, then there could be some penalties or other negative consequences, essentially. Then there's this concept of the quick ratio. And so this one is it's like the current ratio, but it's a little more even focused in terms of short-term liquidity. So we really only, when we're talking about current assets, then we're only going to consider cash and accounts receivable and not things like prepaid expenses, etc., which we would count in the current ratio. Quick ratio, we say, okay, we're only going to look at quick assets, which are cash and accounts receivable, really the things that are going to be turned into cash. Supposedly, theoretically, soon, cash is cash, so that can pay the liabilities, and then accounts receivable ostensibly would become cash within the next 30 to 60 days, hopefully. And also some short-term investments are included as well, because those are considered things that, again, will be able to be converted to cash in a short-term period. So this is just a little bit more of a stringent type of ratio, and but it represents sort of the same thing, more or less, which is how much liquidity does the business have? In other words, how able is the business going to be to pay its upcoming debts? Okay, here's just a breakdown of what we were talking about there. So those are the formulas. Nothing too intense there. Okay, some questions here. If current ratio is exactly equal to 1, then working capital. So remember, current ratio here is current assets divided by current liabilities. So if it was equal to 1, that would mean that these things are exactly the same, current assets and current liabilities. If you have 100 and 100, 100 divided by 100 is 1. And so then they're asking, if that was the case, what would working capital be? And it would be the same thing. As I mentioned, they would be the same thing. If you take the same thing minus the same thing, is from a working capital perspective, it would be equal to 0. You have no excess. If we were to theoretically liquidate or take all our current assets, get cash from those and pay off our current liabilities, what we're saying is there would be no equity or working capital left over. 0. Okay, another question. Which of the following is not included in the calculation of quick ratio? So again, the quick ratio is just a more stringent type of current ratio, essentially. And all that we include from the assets perspective is just cash, short-term investments, and AR. And we exclude prepaid expenses and inventory and other things that are less likely to be converted to cash within the next, 60 days or so. All right, so let's talk a little bit about computerized accounting systems and the computerized accounting environment. As the book notes, they're becoming more common, and I would say it's very rare that a business of any real standing would be using any kind of non-computerized accounting system. I couldn't even imagine any business not using Excel. I'm sure it still happens, that someone is writing down all the revenues and expenses and all this stuff on a piece of paper. But that period of time where paper and pen were used often is pretty obsolete at this point. and there's a lot of accounting systems and softwares that are used. We will have a chance to work with QuickBooks, which is a very common accounting system this semester, just a little bit. And then there is a class at Butte College specifically that can teach you QuickBooks because it is such a common system. And what I would say as well is that basically all the accounting systems do accounting. They all do journal entries, and they all do all the things that we've been talking about so far. They might look a little different, have different little cool things about them, things that they can do, certain types of automation may be built in, etc. But the overall goal of each of these systems, regardless of which one it is to do all the things that we've been learning about: journal entries, preparing general ledgers, preparing financial statements, so on and so forth. So nothing really too much, I guess, to talk about from a slides perspective here, but this is just to keep in mind that we are in this day and age, obviously, in a very digital world, and that type of digital world extends very much into accounting and business analysis, etc. And it kind of extends, I guess I'll talk just real briefly, also beyond just the things that we're doing in this class from the perspective of journal entries and financial statements. A lot of accounting systems as well will assist with the accounts payable process. So you will have systems that will scan in invoices. You'll have those invoices. Maybe those invoices will come directly via email. Maybe there's automated payment portals set up, and so all of the business documentation then hopefully is digital, and accessible somewhere. A lot of cloud-based systems are becoming very popular nowadays, where the information is stored in the cloud essentially and can be accessed from anywhere. You don't have to be inside of the office building and on an office connected computer to their server to access it. So, and I guess I should mention as well, we're at the very forefront of AI and artificial intelligence being incorporated into these softwares. So, in the future, doing things like accounts payable and analyzing invoices, and making payments and things like that, there'll still be a human need and a human touch on all this, but AI is going to be incorporated into these softwares to make it easier, to make it more efficient, to make it more error proof, So if you're going to be doing something and you accidentally make a mistake, the systems are going to be getting better and better, and they already do have controls built into them to prevent you from doing something like a one-sided journal entry, for example. If you do a debit but your credits don't balance or you don't have a credit at all, it's going to tell you, whoa, don't do that, you're doing something wrong. And so that is really, even at this stage, like I said, with artificial intelligence coming in, going to continue to expand and can become more powerful. So the more you know about IT technology type of stuff and how AI works, it's not like you don't necessarily need to be an IT expert or anything to be an accountant per se. But the more tech savvy that you are, that's just a really valuable skill set to have as an accountant, I'll say, because computer systems are such an integral part of all of the things that we do, from an accounting and financial analysis and financial reporting, all these different perspectives, very digital. And that's the world that we live in today, essentially. Okay, so let's wrap this up in summary here, the things that we talked about. So we're talking about preparing financial statements. Remember, using the adjusted trial balance, and we talked about why that was important. We need to have the depreciation expense done. We need to make sure that we've captured all the revenue and things like that, or else our financial statements, if we were to use an unadjusted trial balance, would be missing that integral, key, important information and would be basically inaccurate. So we need to do adjusting entries first. Once we've got our financial statements and our adjusting entries done, etc., we can do these closing entries. And we talked a little bit about the permanent accounts are the balance sheet accounts, and then the temporary accounts are the revenues, expenses, withdrawals, etc. We'll learn how to do these kind of these closing entries, which are very similar every time you do them. Again, I know it might feel a little confusing at this point. The closing entries are really something you have to just practice and learn the process. Once you learn the process and have a system in your mind for how this goes, it'll become pretty clear, I think. But it definitely does take some doing. It's not something that I think you can grasp easily from a theoretical discussion like we're doing here. But hopefully this gives you some context to work on that. We're going to primarily use the income summary method to do our closing, so keep that in mind. There's those two different methods, direct and the income summary indirect method. We talked about preparing the post-closing trial balance. So after we do our closing entries, the trial balance no longer has revenues, expenses, or withdrawals. It's just assets, liabilities, and an updated number for owner's capital. We talked about the classified balance sheet, and remember that that's basically just the same balance sheet we've always done, but it breaks out non-current versus current assets and liabilities, and we looked at an example of what that looks like. We talked about a few different financial ratios and financial statement analysis with the working capital, current ratio, and the quick ratio. Again, financial accounting, if you take that class at Butte, you will to do a lot more with ratios and financial analysis. And then we talked a little bit about computerized accounting systems. So that brings us to the end of our Chapter 6 lecture. Thank you all for following along, and I will see you all in the next video, or I'll see you in class. All right, thanks everybody. Hope you're having a good one.